Hi, Warriors. ECB Day. Michael Weissman, how are you? James Groom. Hi, Ryan. What's a suntan day? Hi, Glenn. Brand. Okay, thank you, Brand.
What colour Lagarde's press
Oh,
conference?
okay, that's what it. Okay, I'm a little slow at 5 a.m. Let's see. Hey, Patrick, Kman, Sinatra, George, Marcus, Tillman. Nice to meet you. Okay, so want to start with is Kman here?
I am very here, Dale. Good morning, and good morning,
Good.
everybody.
Good morning. So, this is the bond that you watch, the 2-year notes, and
Yeah.
we were talking about, that over here would be a breakout. Where's it going to stop?
Well, Dale, we are closing in on 1.5 cut left only, priced in for this year. We raced through the 2-cut barrier, which was around 487.88, and now we are here already. As I was saying on the Flow Show, the combination of that jobs report and the CPI is really something that the market has to acknowledge. And so here we are again. Will it go further? Possible. We are not too far away from your 460.65 on the US 10s as well. I mean, we're in a bit of a zone here, right? For 455.60 on the 10-year, but there's very little reason for this now to at least come back lower. And that's where I was saying, like, if you look at where those yields are now, yes, the other majors are following the trend from a distance, but I think these yields higher here should at least keep the dollar bid on dips. That's my opinion where we are right now. I don't see too much reason for those yields to come back off. We have PPI.
How about new highs? How about the October highs being challenged?
New highs. So we're talking about 4.25, right? Five. Sorry, on the US 2s. We're talking about 5.25, which is close to where they are now. That would be like roughly pricing out all the cuts.
Yeah.
Maybe a bridge too far, I'd say.
Okay.
But there is no reason not to go above 5%. But new highs, I don't know if it warrants it. Perhaps you never know in those bond markets. No,
well, it looks like they have a better chance to do it than the 10-year. And 53.9. We're already past 61.8 here. Okay, so but on the other hand, like economists, either the bonds are going to stop here or are they going to go for a 3? I mean, are we going to have a sovereign debt thing setting up again? Because before this rally in October, there were 3, but I think tactically you could probably take a shot. Been talking about this red dot for a while, around 89. So I mean, if you believe this was the beginning of a larger correction, then this is correcting that, and
it should stop around here somewhere.
Yeah, you would try the long side. Maybe wait for some good action, a little reversal day to the upside or something.
But
anyway,
what's the catalyst for it to turn around? I'm not saying it's gonna collapse further.
There's only one I could think of. There's only one I could think of for it to turn around. That they revert back to what they used to be, what they used to function for as a brisk off vehicle. That's the only one I could come up with. So that I think we're damaging this. We're under that 49 level I was talking about. I mean, they have 2 days to save it. I wouldn't be long.
No, I wouldn't be long either.
See how it's sitting right on that, yeah, 9-day.
Yeah,
And
because the difference is in the last move lower, it went sorry, pretty easily back up, and now we are hanging towards the lows. And
yeah,
that's
Wile E.
different.
Coyote sitting on the 9-day ledge, looking at the bottom of Grand Canyon. But anyway, I'm only looking for 48 initial, as a potential.
Pretty decent move though, 15%.
48 from
Oh yeah,
52.
from 51.
Oh, that's 10%.
Yeah.
Yeah, 10%, 7 to 10%. It starts negating it. I know guys are looking for lower, like 46. And 46 was a pretty big level too. We had the sell off from 46, but anyway, it looks ugly. The only stock, mega cap, I think it's the only one, but I've been following it, holding up the correction is Amazon. And there you go. If this rolls over, it's a problem, because Microsoft is threatening too. Came back a little yesterday. I don't know, heavy. NVIDIA acted great yesterday in face of that. We'll see if this correction's over there. But why don't we get to what the name of our company is, ForexAnalytix.
And a nice Forex.
Yeah, so I'm going to shift to Ryan. How's your voice today, brother?
Good, thank you, mate. I'll be singing in Carnegie Hall by the weekend.
Yeah, have the will call window leave me a ticket, okay, buddy? I would have to be there for that. So here we are, major support. 108's gone. Here we are at 107.
20s, yeah.
Did the world change yesterday for you that it's hard to, fade the dollar right now?
Yeah, no, the world hasn't changed. It's shifted. We've gone, as usual, from one extreme to another.
Yeah,
150 basis points of cuts beginning of the year, less than 50 right now. So, but is it going to change the Fed? They've got to acknowledge this. It's becoming a bit of a problem. 10 months of inflation above 3%. But is it a game changer? Well, the price tells you for the moment, no, we're still holding these ranges. If you zoom out a bit, 107 is a big level as well. A lot of pairs we've hit old ranges, whether it's cable 125, 20, 25, Aussie dollar 65, dollar CAD 137. It's all wider parts of the range, but it's still within the range. We're not breaking anywhere yet. If we start to break somewhere, then something's changing. We get below 107, then you might think, okay, something's going on here. But that might be the ECB later on today, more so than the Fed or the CPI yesterday. So nothing's breaking yet, except for dollar yen, obviously, which is still on planet whatever planet it's on.
Well, there's this one wave guy I respect, and he said, after we took out this, went right to 52 and backed off, that he has targets like around 164, which would be, I don't know, kind of like a continuation. All I could come up with is, 152, and what's this, 46, 58 off of this wave. But I've seen him be right before 164. If we're going to 164, I guess the yield thing would have to disconnect for there not to be the October high yields tested again. So
I've got a question for you, Dale, because you know your option stuff. I bought a 150 put when 152 broke yesterday over the CPI. It's gone up in price, even though dollar yen's rallied another 120 pips. What does that tell you?
That people want protection, and they'll pay up for it.
They're worried.
That's
They're still
you're
worried
right.
about the intervention.
Do you ever, I know a guy a lot of guys in the stock market look for, they call it wise guy action, where they follow the option sweeps. Those are, size coming in on different trades. There's a smart money because they're making, 100, 200, $300,000 bets. They're not buying a 5 lot. So, do you see that in FX options? Can you?
You can do, yeah. I think FX options are traded around a bit more dynamically, maybe than what you see in stocks. There's obviously a lot of shorting of options in indices and that sort of thing.
Yeah.
I mean, Kman, he's the one who I just do vanilla. I just buy them or sell them, and that's me done. Kman does a lot of dynamic stuff around FX hedging, but
What,
I
like
think that's the case.
he does, like applies the Greek to figure out if an option is fairly under or overvalued?
Hey guys,
Yeah, I'm actually.
I hate to interrupt, but we got like 3 minutes before the ECB decision, so I want to jump in really quick, and we can continue this conversation afterwards. Good morning,
Yeah.
Dale. Good morning,
Hey,
Ryan. Good
buddy.
morning, Kman.
Morning.
I'm going to take over really fast, just because this can't, and we can go right back into this conversation following the ECB decision.
Oh, go ahead.
Real quick, you wanted to look at what Elliott wave counts Greg is looking at. Just go on ForexAnalytix, click on Elliott Wave. You can get a 4-hour daily, monthly view exactly what he's looking at right over here. The euro, we are on triangle support, and a break below 107 is going to trip a lot of stops. I doubt we're going to be pushing that ahead of the press conference, which starts in approximately 30 some odd minutes. But we got the statement coming out. Ryan, what are you expecting at the statement here? If anything,
From the statement, the only thing we should really be looking for is an update on the cut timeline. June is when they'll have enough information. So they haven't got enough information yet, but it's how confident they've been in the data so far, and are they confident enough to think about a cut in June or not?
yeah, and are we going to get any? Well, I think the press conference will lead us down the road with July. If we're going to get like consecutive cuts, which that's what the market's really going to be looking for, I think today. Kman, any tweakage on the PEP programs or anything?
No, well, I mean, they should perhaps officialize it, but I'm not expecting too much on that front. I'm actually expecting a very relatively quiet ECB meeting. But if she pens in June, contrary to what's happening on the US yields, I think it may come over as a slightly dovish one.
If you guys, yeah, well, I'm wondering if it's going to be dovish. I hope it does. I hope it is, because it's going to pull apart the differentials between U.S. yields and European yields and the rest of the world too, and give us a lot of volatility. So I hope it's more dovish. If you're in the ForexAnalytix chat room, I'm just going to give you a real quick update. There are a few charts that will lean into euro bullishness and euro bearishness. So if you want to look at the cross rates, those are the ones that we are looking at right there. And here we go. Let's Euro Swiss is flirting with really key support. That's one I've been watching real carefully because I'm looking for a dip. And we are just a few seconds away from the ECB. Well, about 45 seconds. Ryan, any last minute ideas or thoughts here? Your voice sounds better, by the way.
Yeah, thank you, mate. On the road to recovery. No, I'm still long euro dollar, so I'm keeping an eye on that. I'll see what happens with this 107 level.
So I was gonna say, is that your get me the hell out price?
No, my stop on all my longs is at 106.60. So I'm a bit below, but it is an important level. But again, where we close after the ECB will be important. If we've been below and back above, that will tell its own story.
Yeah. Okay. All right. That makes sense. Okay. Here we go, guys.
Unchanged.
Unchanged. Yeah.
euro bounce on it.
Define flexibility and reinvestment redemption.
After yesterday's move, you know, everybody's attention's on producer prices. I mean, you know, if you could see how wrong-footed the market was. Just as we discussed it yesterday, everybody was leaning into dollar shorts. Disinflationary data is coming. Dollar couldn't rally with the move in yields. Let's just sell dollars, and they got you know, completely blasted yesterday. And with euro, and with the move that we saw in yesterday, you can see how wrong-footed the market was. Then today we got producer prices. It's going to be a really, really big deal today. Dale, I want you to go ahead and continue your conversation with Ryan, and you guys were talking about options. You guys can go ahead and finish that conversation. I just had to jump in for the ECB really quick.
Well, we should talk about the euro. So I actually think that we're going to trade under the 106 handle, but I still think it might be a buy after that. So
yeah, well,
that would fulfill the dollar.
I hear what you're saying, and I look at the dollar, and I was just talking to Nick Giovanovich yesterday, and he's like, do you see the dollar going much above 106? And I'm like, technically, 106.60 is where we should be going, but depending on how things evolve, 109 is entirely possible. And and if you're looking at the dollar index, so I don't know,
that'd
Dale,
be like there's a count down towards 102, I believe.
Well, here, let's here's a monthly chart. His count oh wait, we're looking in the euro, so let's go over to the dollar index really quick. Here's the dollar index. Let's look at a monthly. Well, he's still looking for lower here on a monthly basis. His daily counts end around 108, I guess.
Okay. Just enough to take out the 740 high.
Yeah, I mean, that would be in line with basically what I'm seeing here, on a butterfly completion. So yeah, it makes sense. It's all about interest rate differentials now. And this is the conversation that I had with Chris Weston yesterday on the trade-off show. And it's something that, we've been harping on here all year, that what creates volatility in the currency market is when rates go up and down, but more importantly, when expectations, converge and diverge away from central banks from one another. Yesterday, as I was mentioning, we were talking with Chris Weston, and every central bank raised rates, in unison together, and as a result, it's kept FX volatility relatively low. Now, this is where the rubber meets the road. You're starting to see disinflationary data, pop up in different parts of the world, but sticky inflation in other parts of the world, like here in the U.S., and that's going to create a divergence in central bank expectations. Therefore, we're going to see, volatility really start to pick up in the FX market. And then you start looking at the euro dollar and going, okay, we've been really sideways, since the beginning of the year, which would be right here, right? We've been sideways, and we are bound to break out of this range. It's tightening, and we're in the apex of a triangle, which is very whippy. And I think, Ryan, your 106.60, I think, is really very succinct with risk in the market, because we really get a solid break below 106 and change. We're probably going to be trading back, like as Dale said, we're going to be trading back down at 102, 104. I mean, this is going to be probably a pretty wicked breakdown. And again, this is all coming to fruition because what you're seeing is just a very stark difference between data that's being released here in North America and everywhere else. So, I mean, what do you have to say about any of that, Kman? Let's bring you in and in this
Absolutely.
conversation.
Yeah, I mean, big difference between what's happening in the States and elsewhere. The ECB statement, very, very neutral. Nothing new, not pointing at June, contrary to what the all the ECB members have been saying, but we will hear what Lagarde says. Basically, don't change anything right now. If I may just come back on the Swiss, I think we should be a little careful on the Swiss today for a couple of reasons. So first of all, Euro Swiss is getting sold on the back of the ECB, I think, as well. But mainly also for two other reasons that Swiss is being bought today. There's a round of take profit going on the people by the people who are short Swiss, because I think there's two risks overhanging the market now. So the first one is the Middle East, as the US has seen possibilities of Middle East problems with Iran and Israel upcoming. And then the second thing as well is I think the market is a bit worried about Japanese interventions right now, which would possibly weigh a bit on risk also, and risk coming off a little bit. So for the day, I would be a bit careful on Swiss pairs. I've lightened up my positions over the course of the morning, and waiting for what's going to happen the next 24, 48 hours. So I've also shown this on the Flow Show, those channels in Euro Swiss, Sterling Swiss, and they've been put under a little bit of pressure, and I think it could continue for another 24, 48 hours or so.
Yeah, last night this was my my play of the day for on the trade-off show is the Euro Swiss. I'm looking for a breakdown. I think you're exactly right as far as geopolitical risk. I told the traders last night, this is the order of things if there is some geopolitical shock. Dollars over yen over Swiss. So, the Swiss would naturally get a bid, but we know the backdrop of the Swiss National Bank and what their intentions are. So any type of Swiss strength would be probably short-lived. That's why you got to look for some sort of dip here to be on the long side. How far we go probably has more to do with what's happening in the world that you or I or anybody else can't really forecast unless you're a palm reader or you look at lunar landings. Is it lunar landings that you look at, Dale? Lunar charts? No, lunar.
Yeah, I wait for landings, and
You wait for landings.
They're
Okay,
very
lunar landings.
long-term cycles. Yeah,
That's a really long-term cycle.
yeah.
So
the epic
anyway,
cycle.
if you gotta, I think the Swiss, has some downside here. I think you rightfully point out, Kman, and going into the euro is probing, some pretty key support. What are you thinking here, Ryan?
On what, mate? Sorry.
Aside from your singing career, that you're going to embark on, what are you thinking with the euro? Or are you just not trying to think about it ahead of the press conference?
No, we've got to wait for the press conference. The statement was pretty bland. I was actually while you were talking, I've noted one point in the statement. They've actually added a sentence or paragraph on actually mentioning that they will be looking to cut rates. That's not been in any of the other statements, even though the guard's spoken about it at the presses and whatever. It's not been in the official documentation, and now it is. So yeah, we have to see what they set up for June. And we just have to wait and see what the guard happens, and I need to prepare the tanning guide.
And so that's what really got your attention just now. Okay. Hey, Kman, I want to talk to you really quick about the yen.
Mm-hmm.
I had a trader who was in the chat room yesterday. He said, "Hey Blake, why are you selling some dollar yen up here? Because you said we could go all the way to 154, 155. Why are you selling it up here?" And I'm going to give you my answer, and then I'd love to hear your thoughts here. Kman. So First of all, this chart should be absolutely no secret to you. For anybody listening, if you watch the week ahead videos for the last 2 months, if you watch the trade-off show that I do every week with Pepperstone Securities, if you listen here every day, this chart is not, it's looked the exact same way for 2 basically months. I've been looking for a bull flag pattern to complete above 154, 155. I think that you push the envelope above these levels, it starts to become intervention risk. You can see the 6J, I blogged about it yesterday. It's finally starting to break down. Not as a whole, but we're getting up there. I still think there could be more room for the dollar yen to go higher. Mark Chandler brought up a good point that the Prime Minister of Japan is in the United States. I don't know until when, maybe leaving today. It'd be pretty distasteful to start intervening in the FX market and selling dollars while the Prime Minister of Japan's in the US. Great point. Kman, I'd love to hear your thoughts on that here in a second. But the other thing is, the point I'm trying to make here is, I've been expecting this move up to 154, 155, 153 for the last 2 months. Now that we're here, I don't want to miss it. So I'm starting to leg into dollar yen shorts up at these levels because I've been waiting for 2 months for it. Plan your trade your plan. I haven't traded the dollar yen other than maybe a scalp here and there for like months, just kind of waiting for this to happen. So if you want to know why I'm doing it, there's the reason why I'm doing it. I know where my risks are at, and I know if we start getting above 156, 157, I don't want to be on the short side anymore. But I do think intervention risks are real. Kman, I'd love to hear what your thoughts are here.
Yeah, I think they are for 2 reasons. And so we had this blow of 152. We've done about 100 pips, which is in as such, okay, let's say that we done about 1% from the lows yesterday, which is as such, the speed is not yet a speed where they would be completely alarmed. The problem is the fact that they are surprised still of the moves that the yen has done. Dollar yen is one part, but especially also yen versus the rest of the currencies, where the yen has really weakened after the BOJ and the first rate hike. And that is really, they're really pissed off at this move. So that adds to the fact that now the dollar yen is pushing through. So it's not only the dollar that we are watching, and I really think if we see the dollar yen go on its own again and the yen is weakening, I think the risk is really real. And then on the longer term, I obviously I fully agree with Dale's person that he talked about, that we are going to go much higher, because that's still my long-term view on the yen, and whether it be dollar yen or also I still think the yen is in for a weaker environment, despite despite the Bank of Japan hiking, because the Bank of Japan is going to hike not that fast, even though they could do like another 15 BPs very soon, perhaps. But let's see. So to come back on the intervention, I think it's high, it's relatively high, especially if we start to print above 154, because that will be two days or 2.5 sessions or so of a rally where they didn't like the first one. So I think the risk now is high. I'm nearly there. I mean, another 70, 80 pips or so, and I'm going to be fully hedged on my 150.5 call. And I'm going to be all right to be fully hedged, because I think the risk is yeah, for a bit of interventions. Now, how the rest of the market is going to react is going to be a big question, because that will depend on what kind of intervention that they will do. And I've posted some thoughts about that in our chat room yesterday.
Thank you, Kman. We have 30 seconds until the producer prices. I've set you up over here. We got the S&P to the left. It's usually in the middle, but I put it over here to the left just because of the way my charts were set up today. We have the dollar index in the middle. We have yields to the right. As Dale Kman we're talking about earlier, I mean, if you haven't looked at the twos, oh shit. I mean, that's crazy. And that's just, you know, a chart you should be looking at, is you should be watching exactly what's happening with, you know, yields. Here we go.
little bit
Producer
softer.
price is a little weaker. A little weaker.
Yeah.
All right.
Core's a bit stronger, depending on which one you want to look at.
See if there's a
It's all in the sticky zone.
Yeah. Oh, the core. The year over year for core. Yeah, I wouldn't get too carried away with trying to sell dollars here. That's for sure. But one thing it's helping right at this very moment, guys, and I have to point this out. I know you guys talked about, but let's go over here to the S&P. This is really critical support. I mean, like mission critical support. Here's a black channel. You know, this is what we're on right now. That's channel support. Let me get rid of this trend line just to avoid some confusion here. And let's get rid of this support. We don't need that right now. You can see really, really critical support is holding. So just with that as a backdrop right now, you're going to have some people that are, you know, not going to want to be long dollars as a result. But don't forget, we also have the ECB press conference starting in 15 minutes. And that's what's really going to move the needle in the FX market. So, hey, I want to say thank you all for being here today. Dale, I know you have an interview right now, so with Locksman. So great interview is coming up, and I think you all should be here because he's going to talk about the business cycle. Hence his handle. So you're going to get a good macro view of the markets. Ryan, glad your voice is better. Kman, thank you so much for your comments today, especially on the intervention and how you feel about the euro. Really appreciate that. And Ryan, always glad to have you here. And did you guys have the flow show today?
Yeah.
Awesome. All right. So if you guys don't listen to the flow show while some of us are sleeping, make sure you're listening to Ryan and Kman every single morning on the flow show. It's free, just like it is here on F.A.C.E. We'll see you tomorrow here on the F.A.C.E. show. Dale, it's all yours, sir.
See you, team. Thank you.
Thanks, Coach.
Nice batting the ball around. Nice batting the ball around with you. Hello, Lakshman. How are you? Hi. How are you doing?
Good morning, Dale. Can you hear me okay?
Good morning. Good morning. Yeah. Good to see you.
Yeah, nice to see you too.
So, yeah, you know, a lot happens between our conversations, 3-4 months. And, you know, in this business, we're always assessing and reassessing and looking at what data might be telling us. So we've gone to a no landing, no recession consensus out there, Lakshman. I have a feeling that you don't see it that way. And could it be that even though rates are going up on inflation news, that the market is leading the Fed? Because I know Powell wants to cut.
Yeah. He made that. He's been making that clear since maybe December.
Yeah.
He really wants to cut, and even in the face of kind of contrary information, markets roaring and things like that, he's like, yeah, I still need to cut. Just at the last
He's probably reading your research.
Well,
what's he saying?
I wish. I mean, I kind of wish, to tell you. You caught me off guard there. So I'm going to say I wish he was, because I think there's some pretty spectacular missed opportunities in navigating the inflation cycle, which is one of his main things that he has to do. Or he and the Fed really has to figure that out. And it's a complicated place there. It's a bit of a mess. And I know you guys are very practical. You want to see kind of how do you navigate this? We're not going to change them, but we may have a sense for the lay of the land in front of us and how we can kind of guess how they might react to it. Let me back up. Okay, so you have the economy, the indicators cycling down. I'm talking about growth.
Okay.
And we have a tight labor market. We've talked about that. in past interviews. We've talked about, to a degree, the huge amount of stimulus that came on top of that tight labor market. So the combination was pretty intense. And even though we had a couple of quarters of negative GDP back in 2022, we didn't have negative jobs growth. Labor market was tight, and trillions and trillions of stimulus, excess stimulus, was hitting the economy.
I heard the Fed wants to de-emphasize one of their mandates, the employment mandate, because, you know, now they're saying it's because of immigration, and that's going to keep the market strong, and they don't want to be forced to tighten off strong employment data.
I think to your point, right? They may have a bias of tightening or not tightening, as the case may be, and sometimes it's being more dovish as the bias. Yeah. And then you say what you need to say in order to justify that. You can find a reason, you know. So I think that's part of what happens here. But just in the really big backdrop, because I want to talk about where are we in the cycle right now.
Okay.
But in that really big backdrop, you have this kind of recessionary impulse down. You have a tight labor market because of earlier immigration issues and then COVID pulling people out. And then you dump trillions of dollars of excess stimulus on top, and yeah, things are tight. And you don't have a recession in the sense where to have a recession, you have to have output contract. That happened, but you didn't have jobs contract. We think we know why. I mean, these are pretty straightforward things I'm saying here. Labor market tight plus trillions of dollars. So it's hard for jobs to go negative. Okay. So we're still, you know, I was talking with a client the other day and they're like, hey, are we done with this? Is that stuff out of the data yet? And while much of it is, it's not all out. We've still got some, I'd say, like PTSD on the tight labor market, especially for some of the smaller businesses where they're very reticent to let people go because they had such a tough time hiring. They had anyone with a pulse they had to hire earlier, and so they're very careful about that. And there's still some stimulus getting pushed out. I mean, you couldn't shove it all out.
The infrastructure bill?
Yeah, so there's stuff trickling out. It's on different budgets everywhere, and you know, you got to use it before the end of the year, kind of thing. That whole thing that whole ship has sailed, and it's happening. So all of that adds up to what we've described as a tug of war. We have this cyclical move down. We've talked about it with our labor stuff earlier, where all the levers that they can pull, they're pulling all the variable levers they can pull short of firing people. They're pulling, which is showing the cyclical impulse down really hard on the economy. But all that excess stimulus is keeping things elevated, and in particular on non-discretionary spending. So really big picture, education and health. That stuff's running, you know, around 4% growth rates. And you can toss government in there too. So those kinds of jobs, which are tons of jobs, last year we're running at 4%. This year they're still pretty high up there. And so even though all that discretionary cyclical stuff is coming down, that's offsetting it. It adds up to slowing jobs growth, but it's coming down year over year, and no recession. So tug of war continues. That's the backdrop on which we're going to switch cycles from the U.S. economy. I want to talk about two other cycles. One is global industrial growth. It doesn't have a lot to do necessarily with the U.S. economy. It's global. It's bigger than the U.S. It's just really the industrial sector. It got creamed, right? It was in this post-COVID world, so much stuff has been off the charts, but all that global industrial stuff got really smacked to the downside really hard, and what was notable for an extended period of time. And part of the mechanisms in cycles, and again, I'm not a model builder, we're looking at patterns, the ebb and flow and cyclical indicators. So part of the mechanism that creates a turn to the upside is a long time out in the desert, right? And so you do have this kind of squeezing and drying out, and that's what cycles do, is they reset for the next leg up. And that happened globally. Remember at the beginning of 2023, everybody jumped the gun and said, "Oh, we're having a global industrial upturn. China's reopening. We're good to go. Let's go long oil."
Yeah,
And it was
people,
exactly it was the
people
wrong
got the
trade.
reopening wrong, definitely.
It was all wrong. And I think people are probably a little burned on that. So they're like, "Oh, I don't know if I believe it this time." But actually, global industrial growth is turning now. And while China is a mess, the goods and export sector is gearing. So that's not going to solve China's problems, but for about 20% of the share of the Chinese GDP, it's gearing. It's engaged in that global industrial upturn, as are industrial sectors in Europe, where things are pretty bleak at the moment, and even in the
I heard
US.
energy demand was really high in places like Italy, which, you don't need a lot of energy unless there's something going on economically.
Yeah, and so
right?
exactly. So very short, like the near term, our longer leading indicators turned up, and you guys can
Can I
see some.
pose
Yeah.
a hypothesis to you, Lakshman,
Yeah.
that a recession in the real economy is triggered by some type of financial event or crisis that that dilutes confidence in the economy. And what I'm talking about in particular are the regional banks. And, I just want to show you the regionals because we all know the market went parabolic, right? It went parabolic. And all that really generated for something, KRE, and that's why the Russell really hasn't gone. Plus, the Fed just closed the rescue facilities that they had. And look at this on a weekly.
Yeah, I'm trying to
All
get
right,
my screen
I'm
so I
just
can see
saying.
you. There it
So
is.
yields
There
are
you are.
heading up. Yeah, yields are heading up again. So this is really it. So we
Yeah,
had
they're
a
going to
pair
get
of
smushed because, well, this is the higher for longer. So, right. So that's
yeah.
going to mush these
So
guys.
that isn't it going to just no
So
rescue facilities again? Could it be just confidence in the banks?
look. Here's how in all my years of research, and there's a few, and building on my mentor and my mentor's mentor, right? So how do you get a recession? I think you're onto it. I want to restate what you said. Okay. It's cyclical vulnerability combined with a shock. Now, shocks are actually happening all the time, and it's kind of like, which is the one that is a trigger? And when you're vulnerable, a negative shock is a really big deal. And when you're in a cyclical upswing, you could take a negative shock and not have a recession. Okay. So go back to the tug of war. I'm talking about you got a cyclical impulse down, offset by excess, a lot of trillions of dollars pushing the other way. Okay. So the tug of war is going on. In fact, what's happening is you've got this window of vulnerability that's opening, and then the excess fiscal stimulus is pushing it closed, and then it's opening and closing. That's what's going on right now. If the shock hits when that's open, you get a recession. And the shock could be a financial shock. But there are times when you've had nasty financial shocks without recession, like, for example, 1987. It's a big financial shock. The recession didn't happen there. In fact, people thought, oh, we're good to go. It's years later, no problem. And then in 1990, there was a recession. The shock in that instance, in 1990, 91, was Saddam Hussein invading Kuwait. And there was a spike. It's really the rate of change. It's not the level of energy prices. It's the pace that they're changing if it happens really fast. And so,
well, there's
that,
another candidate,
yep,
Lakshman. Now I have WTI up there. So, you know, we start closing over $90. The war in the Middle East expands. The Strait of Hormuz is blocked this
there's a
summer.
ton of supply. Look, there's a whole show on the supply problems, and let's agree, there's the supply doesn't look great on the global industrial upturn. Okay, which I was just talking about, and this is on. You can go to our website. We have this thing called the column, and there are articles about this on there that you could take a look at. And so the global industrial upturn is real. That's happening. And if you think that through, one of the things that happens when global industrial growth moves to the upside is that short leading indicators like the PMIs and the commodity, if you go to Resource Center, and the commodity, industrial commodity price inflation, those things are very short. They're leading indicators, and they're going to move with the direction of global industrial growth, and they're moving to the upside. So you have a combination of a cyclical upturn globally in industrial growth and all of the litany of supply things that you just talked about.
Yeah.
Okay, so we know that's part of the landscape of 2024. Now let's look at inflation. When you look at inflation, if you go to the column, all these things are there at that the bottom left. It says the column there, and if you go to inflation, which is a separate cycle, the fundamental misread of the Fed and many, I would say, you know, it's not a knock on people, it's just that they just don't know this really well, is that underneath the column there's some inflation stories. Is that inflation, like growth, it's different than growth. They have different cycles, but inflation, like growth, is cyclical. So now, if you accept that, and I'm happy to take questions on this, but I accept that, and I've been looking at inflation for a long time, and we've done a lot of work on this since 40-something years, and
I used to see you on the Financial News Network, Lakshman.
now compare that. We were looking at some archives. I found some.
Remember that?
Found some interviews. I found some interviews with me debating Peter Thiel from like the early 90s. It was pretty hilarious, and Kudlow, and it was these are funny. But I'm telling him, I was saying the same thing then I'm saying now, which is, hey, look at global sensitive industrial materials prices. Those are linked to global industrial growth. But on inflation, it's cyclical. And if you compare that to the narrative, which is the Fed narrative or the Wall Street narrative, which is inflation is cycling down and it will go toward the target and stay there. So just on the face of it, I would say, that's not, I hear your story, but that's not how anything has happened that I could observe in the rearview mirror. I'm not even forecasting. I've just never seen inflation do that.
I called that a Wizard of Oz forecast.
Yeah, it is what you need it to be, right? So here we are. That's the presumption. So I'm like, yeah, that's a pretty shaky presumption. Let me look at the forward-looking data on inflation. And if you let me share the screen, I could show a couple. I'll show a couple of those real quick. And what you C is that the forward-looking indicators of inflation correctly anticipated the downturn. And then they have gone sideways. Let me just
so
get
you
my
click
share
the
here.
share screen. Yeah,
Yeah, sorry,
it's all right.
I need a producer.
Early.
You're slick. You got producers and all this stuff going on. Let me get in here. And real quick, there's your
Okay.
jobs growth at 4% for non-discretionary.
Yeah.
Non-discretionary. And here's your discretionary jobs growth, it's just collapsing, right? That's that real tug of war I was talking about. Here's the strength of the global industrial upturn. That's a leading indicator, long leading indicator, short leading indicator. Here's actual industrial production diffusion index. It's bottoming and starting to move to the upside. That's not over. That's going to keep going. So then this is international inflation. Bang. You got to be looking to the upside. So whatever happened with PPP or whatever the ECB is saying right now, the lay of the land is going to be to the upside on inflation as the year progresses. This is a leading indicator. This is a leading indicator also. They tend to focus on this, which is the rear view mirror coming down. So
we declared victory over inflation a few times in the 70s, and it came back.
Yeah,
it was like
exactly.
3 cycles, right?
Yeah, this is, I mean, this doesn't have the latest data point, which is a little up. The gray line is the current environment. The black line is the 70s. I'm not saying it's going to be this magnitude, but the point is inflation is cyclical, and it's remained cyclical since the 70s, all through now. It still cycles up and down. And so the Fed is kind of betting that this gray line goes down to 2% down here.
Yeah.
And stays there. And I'm like, yeah, I don't, maybe, but I don't see that in the patterns in the past. And when I look forward at forward-looking data, this peaks before this. These are our leading indicators globally. And they peak before actual inflation peaks here.
Okay.
And now they trough. This one goes first, this one goes second. And these indicators have edged up from there, okay? This is still up there. That's a diffusion index. It's not magnitude, it's diffusion, directional. So it's hanging out up here. This one's starting to move up this way. And this, I bet you this thing is bottoming right now, okay? And so the ECB probably has to run out in front of it and say, hey, we're good, everything's good, mission accomplished. And then in retrospect later, they'll see that it's turning up. That's
so
based
on your stuff, Lockman, is it a possibility there are no Fed rate cuts this year?
Look, anything's possible. I think that by hook or by crook, they want to cut. So they may look, the Fed is fully capable of making mistakes, right?
Yeah.
Our
Well, what's a motivation for them to want to cut if the numbers aren't doing it, and now they're going to de-emphasize employment? Is
all
it
the powers that be want cuts?
Okay.
I mean, you could, public and private sector powers that be want cuts. Everybody likes easy money. So, there's a lot of pressure, right? I mean,
could it be Paul's fear of a Trump presidency, Lakshman?
Could be all. I think everything's in the mix.
Okay.
I think you want to say, I promised cuts. For whatever reason, he really wanted to promise cuts earlier. And you always want to say, I've accomplished my mission.
Well, he's used to not saying that. Maybe not used to it, right?
Yeah. But look, I just want to, I like the Wizard of Oz, right? Pull back the veil. This is an inflation cycle upturn in the forward-looking data. Look at that thing. It's huge. Yeah. It's off the charts. You'd have to be blind to miss the upturn. the Fed was calling all of this transitory.
Yeah, right.
All right.
Yeah.
Okay. So here we have the downturn in the FIG. It's interrupted right there. That's war in Ukraine here.
Right.
And the way I'm just asserting, but the way a lot of people think, including big institutions like the Fed or whatever, there's just a lot of inertia in betting that this line keeps going down. The problem is it's cyclical. It's a cyclical line. So if we know this, we could say, well, when is it going to turn? And that's what the leading indicator is designed to do. So it turned down. It's correct. Inflation turned down. Okay, good. But to
The
my
top
eye, and
index,
I've been doing this real time since 1990.
the top
That's a long
index has
time.
given up very little. It's corrected more in time
To
than in
my
price.
eye, this is your tell. When this thing goes sideways like that,
Yeah.
I gotta say, whoa, something is up. And more recently, like I think we got an update last Friday. This is moving now up here. It's about, if you see my pointer, it's about up here now.
Yeah, I do.
And the thing is that in this century, in this new century, all this sci-fi stuff and AI stuff, in this new world that we live in this century, since the beginning of the century, inflation cycles globally have been pretty synchronized. So in this 11-country future inflation gauge, it includes the United States. The United States is holding this line down with this input. This is one of the 11 future inflation gauges in the previous chart. I was just telling you this one's starting to move up here. So my basic sense is the tug of war in growth continues. The leading indicators on growth have firmed a bit. That is true. So I don't think the tug of war game is over, but right now, we can make up stories around why it's election year, whatever, but the leading indicators are firming on growth to the upside. When I look at global industrial growth, boom, that's a clear, solid one on demand to the upside in global industrial growth. So the manufacturing sectors of whatever market you're looking at, US, Europe, Japan, even China, they're all going to gear a little bit here.
Okay, so we're going to have good growth, clear sailing for the next 6 months at least
for industrial sector. Okay, I'm not saying that the high end discretionary services are going to go crazy. I'm not sure about that. Okay, rates do sometimes matter. It's like, how long can you get credit for? I don't know. The CRE stuff is at risk, but on the other side, the government spending and infrastructure spending continues apace. So I think in navigating 2024, which has that huge political thing on top of it, you've got the tug of war in the US right now. Leading indicators of growth are firming a bit. Globally, a separate cycle, they're clearly to the upside, which is supportive from the demand side on industrial commodity prices and activity. And then you've got a global inflation cycle upturn, of which I'm really concerned about the US. I know inflation in the US is cyclical. I know the narrative is it's going to go down towards 2 and hang out there. And there'll be all kinds of stories about, hey, it was used cars or it was something else that goofed it up. But when you look at, we don't do additive inflation like that. We're not adding up models. So we're not coming at it that way. We're looking at the drivers of inflation. And the drivers of inflation is that top line. They came down, they've gone sideways over a year, and now they look to be edging to the upside. I think that's your big risk.
Okay, so that's an avoid bonds.
Yeah, it's like you want to be in stuff that does well in an inflating environment,
Like
and
miners.
if you want to tie that to some economic activity, I'd lean on the industrial sector.
Okay.
Does that make sense?
Yeah, it does actually.
Okay.
You know, the leadership in the market's going to change, and
Is
I
that
think
that's
it's
what
going
it
to, yeah, yeah, and that's what your work is confirming.
that's what the
That,
work's confirming. I don't know, like, look, currencies are really messy, but they feel like they're going to get lively
yeah,
because you have central bank narratives, and let's say basically they all want to cut, right?
yeah,
Maybe the Japanese they're like, yay, we did one hike and then we're good because they've got to finance all their debt. But let's say inflation just keeps not cooperating with that story. Now, all those central banks, they have different reaction functions. They've got slightly different constituencies they're dealing with.
right.
But it feels like that's a place for some action.
Okay. Yeah. So dollar
So
volatility.
you guys are all trading, so I'm like,
Well,
it feels
you
like
know,
it's a
does this
bouncy.
keep?
It's going to be a bouncy environment,
Okay,
right?
bouncy. So, is this the dollar in the tug of war with euro, with what's happening and what you're seeing? Tug of war, or
I don't
do
know
you
if
give the dollar?
that's almost too fair because you're saying it's balanced. I don't think it's that balanced.
Okay, so the
I think
dollar has
they're
the edge.
yeah, on that one, you probably got to as much as I mean the deficit numbers are mind-boggling in the US, but it's still the big dog.
Yeah. U.S. exceptionalism, I hear all the time.
It's still the big dog. We'll see what the bond market, if the bond market vigilantes come out of hibernation. We'll see.
Well, they
Let's see what
certainly
happens.
have in
So
the last
look,
few weeks.
Dale, bottom line, you got to watch the future inflation gauge. That's the thing, right? If that thing is just like kind of gently bouncing around and not really taking off,
Yeah.
all right, we can keep this party going.
Okay.
If that thing moves, and it can move, you saw the charts. And if
Yeah.
you look in the column on businesscycle.com, go to resources and go to quote unquote the column.
So that's a
Then,
shock then, Lakshman.
yeah,
An
that's a
inflation
shock.
shock.
Yeah. And so how are we going to tell the story, right? The Fed's going to have to come up with some line. The bulls will have to come up with a line, right? I think it really trips up the real estate side because the plan has been to hope for the rate cut.
Yeah.
Now,
Right.
okay, so we went from 6 or 7 to 3 or 4 to 2 or 3, and maybe they'll sneak out 1. But I don't know if that's enough to hold that story together.
Yeah.
That's a question, right? So
yeah.
I'm all there's plenty of fragility out there right now. Bottom line, U.S. leading indicators of growth, they're firming a little bit. So tug of war continues, but for the moment, they're kind of trying to close that window of vulnerability. Global industrial growth to the upside, demand on commodities.
Yeah,
So,
copper's been flying. It hasn't just been precious metals. It's
and
been
then,
copper.
well, so look around at it's other industrial stuff, building stuff,
Yeah.
packaging stuff, all that's even.
Stuff.
I mean, one of the things that's in our commodity index is what the heck is it? Tallow, right? So that makes soap that goes into factory cleaning.
Yeah.
So that's how granular we can get, and you see they all move as a group.
Yeah.
And you can't trade that, I'm afraid. It's hard to trade that. But
no, you just have to pay 30% more for everything.
So be leaning on the side of things inflating, be leaning on the side of industrial activity to the upside. Tug of war continues, and look, I'm with you. You got to watch out for what could break.
Okay. Yeah, definitely. And really great to talk to you again, Lakshman.
As always.
We've been doing this a few years. I want to thank you for coming in with your giving spirit to edify our community.
Hey, I
really appreciate it.
I mean, look, I appreciate you keeping the group together. And I feel like I'm getting to know everybody. And Take a moment to get outside. It's spring. I got to do
Yeah.
that too,
Yeah.
if you can. And I'll
Yeah,
see you.
smell the
You know,
roses.
you get together with Melinda, and we'll schedule something, a check-in over the summer, and see if the future
Okay.
inflation gauge moved up.
Thank you, my friend, for being here. Appreciate your view. Take away inflation, tug of war.
You got it.
And Lakshman, and look him up on X at Business Cycle, and go to his website I was showing
Yeah.
earlier in the day, and great content.
Dale, the other thing that we've done, go to our LinkedIn Economic Cycle Research Institute, because what we do there, they have a pretty good setup, and somehow they push out, without being obnoxious, we have some setting where you could just get a newsletter, and it's like, hey, here's what happened with whatever, global growth, inflation, but it's not like in your face and annoying.
Yeah.
It's, once a month, or
Yeah,
it's not even that.
Yeah.
Okay.
So check them out on LinkedIn too. My comment on LinkedIn about today was, I always enjoy having a conversation with my friend Lakshman, and I did again.
And Dale, all questions are always welcome. So let me know what you want. I'm here for those.
So there you go. And that he's making himself an information asset to you guys. Check him out and say hello. Thank you, Lakshman.
Thank you.
I'll see you in July.
Take care.
All right, buddy. Bye. So that's a wrap, everyone. Hope you enjoyed it. I always enjoy talking to Lakshman. You could join the team in 9 minutes. So you only have 9 minutes to get ready for the morning edge. So go shave. Good luck today. Don't just count your pips, count your blessings.